Welcome to Real Estate Investing Abundance, the show for busy, fulfilled professionals like you to learn how to develop financial independence built on solid, passive real estate investments. Now, here is your host, Dr. Alan Lomax.
Hello, enlightened investors. I'm your host, Dr. Alan. Delighted that you've joined us today. Are you a busy professional, passionate about the work of your calling, yet realize that even though you love what you are doing, you're exchanging your time for money? You know that if you were to lose the ability to exchange time for money, your financial well-being will be in jeopardy. If you can relate, I have great news. Steve Tucker Capital is an investment company designed for professionals to develop financial independence built on solid, passive real estate investments. Remove the anxiety of an uncertain financial future and go to stevetucker.com. Get your free one-page 10-step guide to passive real estate investing.
Enlightened investors. We've all heard the term crowdfunding, and many have probably contributed to a person or a cause through one of these many crowdfunding platforms. But what does crowdfunding have to do with real estate? Well, with us today is the expert in real estate crowdfunding, and she is here to help us understand why we need to know more about crowdfunding because it isn't going away. In fact, the opportunity is about to get even bigger. And I am thrilled to have the opportunity to sit down with Deidre Woollard, who is a writer and editor and who has been in real estate investing for the last 2 decades. She has been in all aspects of real estate investing, from luxury real estate to the latest proptech. And I don't even know what proptech is, but I am going to find out today as we talk with Deidre. So Deidre, before we get into what it is that we need to be up to speed on in crowdfunding in real estate, and what is the latest in real estate investing, and what in the world is proptech, share with us a memorable experience from your formative years that helped you to be the person that you are today.
This is one I'm probably a little embarrassed about, but when I was about 10, and it's the reason that I ended up going from 3rd grade to 5th grade. And what I did that got me in trouble, I was a little bit bored and a little bit rambunctious. I wrote a mean poem about the lunch lady. So somehow this poem got circulated at school. This is like back in the days of mimeograph, where someone snuck into the office and photocopied it, and it got distributed, and I got in all sorts of trouble. But it really taught me the power of words. I don't think anything else ever would have, was that I learned that there are things you should not do and that things will get distributed, and not to say things like that and not to be mean. It taught me a lot about kindness as well.
Well, what an experience at a very early age. Always good to learn about consequences. It takes some of us a much longer time than 10 years old. So you're an early starter. Well, Deidre, what do investors need to know about Regulation A?
Well, Regulation A is interesting because it is part of the crowdfunding legislation that essentially lets everyone invest, but it's a little bit different than just kind of everyone goes in. One of the things about Regulation A is that you're not necessarily investing in an individual property. You're usually investing in a private REIT or private group of properties. So it's a little bit different than a Regulation D and the accredited investors, where you're usually putting in your money and it's going specifically for one property.
Okay. Well, you just mentioned REIT, and there are some differences here between a private REIT and a public REIT, and probably people are more familiar with the public REIT. But what is the difference between a private REIT and a public REIT, and why is it that through Regulation A, people can go ahead and invest in private REITs through a crowdfunding platform?
Well, a public REIT, we've obviously have all invested in REITs that trade on the stock market, and those are pretty standard. They've been around since the 1960s. But Regulation A in real estate crowdfunding, it's all so new. And so these private REITs, they're definitely a lot newer. One of the big ones is Fundrise. I think probably most people have heard of that. And so these, you're really participating at a much smaller level, but you're also, they're investing in things like single-family residential communities or multifamily apartments. So you're seeing a lot of properties that they're buying and holding, but also buying and then selling again after a short hold.
Enlightened investors will be right back after this important announcement. I have a big ask that will only take a moment of your time. Ratings and reviews are the lifeblood of our podcast. So to leave a review, iPhone or other Apple iOS device users, go to Apple Podcasts or iTunes. For all you non-Apple device users, go to podchasers.com. On either platform, search for Real Estate Investing Abundance. Once found, please leave a review and a rating. Subscriptions are also vital to our show's success, so please be sure to subscribe on your favorite podcast app. It is free to subscribe, and you can unsubscribe at any time.
So is the REIT actually the crowdfunding platform, or do crowdfunding platforms invest in REITs?
A lot of crowdfunding platforms develop a certain amount of private REITs that they then pool money into.
Okay. So the REIT isn't exactly the crowdfunding platform, but crowdfunding platforms oftentimes develop their own REITs.
Exactly.
Am I understanding that? Okay. So why is diversification in real estate as important as diversification outside of it? I mean, we always hear that term. Any advisor you go to, financial advisor is going to tell you that you really need to diversify. So why is that important in real estate as well as in the stock market or bonds or whatever?
Well, I think the great thing about real estate is that you really can diversify inside of real estate in so many different categories. The pandemic was a great example of why you, for example, don't want to have everything in retail, or commercial office right now is also another area that it's going to bounce back, but it's going to be a little bit of a journey. So within real estate, you're well diversified, you can capitalize on the things that are happening. So when the pandemic was in full swing, from a publicly traded REIT perspective, we saw a lot of interest in data centers and communications, things that were fueling the sort of work from home industrial real estate because of e-commerce. Things like that were very, very popular during that time period. And industrial real estate, for example, has just boomed like crazy. So really, inside of real estate, you can look at the different trends that are happening, and you can diversify a little bit in industrial, a little bit in housing. Obviously, there's the ongoing need for affordable housing is so vast. That is a relatively safe place to be. But again, we see it changing by location. We saw what happened with New York and San Francisco. We've seen the migration to the Sun Belt, which was a trend that existed before the pandemic, but is even bigger now. I mean, Phoenix was one of the most popular markets last year. So you can diversify by sector, you can diversify by location. There's really a bunch of different ways you can diversify inside of real estate.
And I suspect that investing through a crowdfunding platform rather than investing directly in a syndication does a couple of things. First of all, it gives you that opportunity to diversify. In most syndications, you're going to have to put in a minimum of $50,000. And in the crowdfunding platforms, is there a minimum on that? Could you put in $10 in one crowdfunding platform?
The lowest minimum I've seen is 100, I believe, 100 or 200. Usually they start around 500. Some of them, Realty Mogul, for example, they start at 5,000. But a lot of the crowdfunders, you're absolutely right. For accredited and non-accredited, it tends to be lower. Like some of the accredited deals on something like CrowdStreet, which is one of the popular platforms, they may usually start around 25,000, but can be as low as 10,000.
And so there's a lower entry point. And then I suspect the other advantage to crowdfunding is that if you're going into a syndication, your funds are going to be tied up for an extended period of time, probably averaging around at least 5-year period of time. So with a crowdfunding platform, can you go in like you do in the stock market? You can invest in it today, and then tomorrow you can get your funds out of there? Or do those vary from crowdfunding platform to crowdfunding platform?
It definitely varies from platform to platform. Most of them have a year-long hold, some of them a little bit shorter. If you're doing the Regulation D deals, those are most likely you probably can't take it out because it's supporting a single project.
We'll be right back after a word from our sponsor. As an industry-leading relationship-focused design-build construction firm, Mosaic Construction has worked in many different asset classes from multifamily to retail, medical, industrial, and commercial. Mosaic Construction works to execute interior and exterior renovations with their team of trades and project managers. Their experience with value-add improvements has resulted in increased ROI and long-term value of the assets. They work nationally in partnership with local trades to deliver thoughtful, problem-solving construction management solutions to all their clients. For a personal, no-obligation consultation, call Ira Singer, 773-491-3145, or email Ira at mosaicconstruction.net. You can also find Ira on LinkedIn.
But if you're invested in one of the Regulation A projects, which is a REIT, which holds a bunch of different properties, you probably can get your money out at some point, usually after a year-long hold. There may be some fees involved. It absolutely depends on the platform. And it's one of the reasons that when you're looking at these things, got to pay attention to the fees. Every one of them is structured just a little bit differently. And you always want to ask yourself with a real estate crowdfunding platform, where are they making their money? Where are they getting their fees? Are they making their money through completion of the deals? Are they making money from having more capital come in? You really want to make sure that you understand that. And they all publish offering circulars that are all available online, so you can do your due diligence that way.
And so there's no standardization in terms of fees, no regulation and what a platform can charge. So it is a self-regulated market in terms of fees, or?
I think there are some limits on what they can charge, but you brought up a really good point, which is that I feel that real estate crowdfunding, because it's in such early stages, there are SEC regulations, but there probably aren't as many as they're going to be. And there's probably going to be some changes back and forth. Like, for example, we saw last year that they changed the Regulation A requirements that now, like if you have a Series 7 license, you can be considered an accredited investor. So they're changing those requirements to be from just a monetary requirement to a knowledge requirement. I suspect that's going to continue. I think that we're all still figuring out real estate crowdfunding and what it can do. I mean, even just like 10 years ago, a lot of developers would never have tried it. It would have seemed just too much work. Why would you want to, have 100 investors contributing $1,000 when you can just get $100,000 from one person? So it's still an industry that's definitely growing and kind of learning along the way.
So could you give us some examples of the various different types of fees that an investor should be looking for?
Well, you kind of want to see what the percentages are on what they're taking out. So you want to see when you're putting in money, probably going to be getting quarterly distributions. So you want to see what those distributions are and if the fees are being taken out there. Because a lot of times they'll tell you they don't charge fees, which means that you don't have to pay more fees, but they may be taking those fees out, distributions.
And even though they say they're not charging a fee, if they're taking them out of distributions and they're taking that fee every time there is a distribution, it could cost you a whole lot more than an upfront flat fee, I suspect. Is that the case? Or?
Yeah, that's one of the reasons to kind of do your homework on that.
Okay. So is there a typical kind of fee structure, or is it just wide open at this point in time?
I would say that typically it tends to be related to the distributions, and it tends to be a percentage of the overall gain in the quarter.
Okay. Would there also possibly be a fee? Not only are they taking a percentage of the distributions, but I don't know if this even applies, but on the sale of a property, which is often where the biggest return on investment is going to come, is there going to be fees associated with that?
With the Regulation A funds, you don't really get like a return of capital the same way that you would if you're doing an accredited investor fund and the building is sold and capital is returned because you put in a certain amount. It works a little bit differently. It's more like your capital gets put toward the next deal. And so you continue to get those distributions until you take your money out.
So do distributions vary, or is there a set distribution once you go fund?
It definitely varies, certainly by the success of the fund itself, because these funds are constantly acquiring and selling. So their overall portfolio is in flux. So it absolutely changes over time.
Which could be a good thing or a bad thing, I suppose.
Well, they're also always changing their strategy too, the same way that a publicly traded REIT would. If, for example, Fundrise, they announced earlier this year, they got $300 million in a credit facility from Goldman Sachs. And one of the reasons they're doing that is they're pivoting towards single-family build-to-rent communities, which we've seen overall, partly because of the pandemic, this strong interest in single family rentals. And we've seen a bunch of companies just amassing those large rental portfolios. So some of these crowdfunders are looking at those types of things. Some of them are looking at workforce housing. We see a variety of different strategies being used.
We'll be right back after a word from our sponsor.
Would you ever invest all your money in a single stock? Very unlikely. Yet investors are willing to risk $50,000 to $100,000 in a single property in real estate all the time. Investor is the world's first customizable real estate investment platform. Investors can build their own custom portfolio selecting investments across multiple asset classes such as single-family homes, multifamily, student housing, self-storage, and shopping centers. You can also invest across multiple markets and different time frames. Investor also enables other real estate entrepreneurs and syndicators to build and use Investor's infrastructure and cloud platform to create their own customizable real estate funds. To learn more, visit us at investorinc.com. Investor, real estate investing made simple.
Well, as this goes forward, looking in your crystal ball, what trends should passive real estate investors be paying attention to, and what can they ignore?
It's hard to say what you can ignore. I would say that you can ignore, and this is for stocks or anything, you can kind of ignore the day-to-day. Don't panic when you see news about a particular area or you see news about the stock market or anything like that. Don't panic. You and I both believe in the long-term value of real estate. So certainly you don't want to base your decisions on something temporary. I would say things you want to keep an eye on. You want to make sure that you're keeping an eye on the reports that you receive. You want to keep an eye on those fees. You want to keep an eye on what the crowdfunder's strategy is. And you really want to make sure that you understand everything. I think that sounds really basic, but a lot of people don't want to read through an offering circular. It's not exactly exciting reading sometimes, but it pays to really do that.
Yeah, that's true in any aspect of commercial real estate investing.
Yes.
As those documents are not very interesting, but they are very, very important. Well, what's your biggest lesson that you have learned from covering real estate for the last 2 decades?
I think the thing that I've learned is that it's always changing. And I think that's one of the things that's fascinating. I think the other thing I've learned is that when people talk about disruption, they tend to see it as a very immediate thing, and disruption is a very slow thing. Covering a company like Zillow or Redfin for the last 5 years, people talked about them as being a disruptor, and they are, but it's a slow process. Even the disruption of iBuying, which has been covered a lot, still only represents about 2% of the total sales in real estate right now. So very small part of the market. So disruption happens, but it tends to happen a little more slowly than people think.
It's always frightening. But yes, I think you're right. Big disruptions often take time, unless, of course, it's the 2008 recession, which hit us overnight. But they do come fast, but I understand what you're saying in terms of the disruptions within markets. Well, why do many investors overlook the opportunities in commercial real estate investing?
I think it has to do with it being a little less understandable, because I feel like for anyone who's getting started in investing in real estate, you've probably bought your own house before. So you've probably gone through that process. So that feels a little more safe. So I think a lot of people tend to start with, you get your own house, maybe you do a house hack, maybe you do, a quadplex or something like that. Then you get up to a 10-unit apartment building. That progression, I think, feels a lot safer to people. And the other thing I think with commercial is there's a lot of numbers that you need to understand. Leasing structures may be a little more confusing for people. Things like a triple net lease. Well, what does that mean? If I've got a business in here, what kind of contract do I need to have? What kind of insurance do I need to have? It can be a little bit complicated if you haven't ever done it before. Residential and multifamily just feels a little more understandable, I think.
I think you're right. And that's unfortunate because there just are many more, I think, investment opportunities in the commercial segment than there are in residential. And residential, even though it seems more comfortable, it can get very tedious quickly if you're looking to scale your investing. 2 or 3 homes are nice. You get into 4 and 5, it becomes a job, and you get into 10 and 20 single family homes. You've got a job, and it's not anything close to passive investing. So, yes, behooves people to step out of their comfort zones and invest commercial real estate because that's where the opportunities are, as far as I'm concerned. Well, you talked about crowdfunding and the fact that it's not going away and it is going to get bigger. And there are clearly some advantages to that. But what are the disadvantages in crowdfunding as opposed to investing directly into real estate syndication?
I think some of it comes down to a lack of control, because if you're in a small syndication, you probably have direct access to everyone involved in the deal. Crowdfunding, you're one layer removed. So you are really trusting the platform to some extent to have picked the right sponsor, and that can be a little nerve-wracking sometimes. And even things like taxes, getting your K-1s. If you're dealing with a real estate syndication, you probably know exactly who to harass when the time comes. If you're dealing with crowdfunding platform, maybe that's a little more complicated. So there is that extra layer. I think that's the thing that might be a disadvantage sometimes.
Since you brought up the aspect of taxes, investing in a real estate syndication, you generally are going to get the tax benefits of depreciation. Are you going to lose that in a crowdfunding investment?
You don't get those benefits inside of a Regulation A. You really were probably, for accredited investors, Regulation D investments are where you are still going to get those passive losses that you might want for your taxes.
Well, you mentioned also affordable housing, and we keep hearing the crises that is in affordable housing. So why does this represent an opportunity to do well and at the same time to do good?
I think that this is such a problem that we're starting to see some of the real estate crowdfunders really look at workforce housing as something that is an investable idea. And I think it's going to be necessary. And I'm covering this from a variety of different angles because you have modular construction, mobile homes, manufactured housing. There's so much need for so many different types of housing right now that I think that we're going to see more opportunities. Another aspect of crowdfunding that I haven't really talked about, but is a little different than traditional real estate crowdfunding, is that you also have these companies. There's a company called Modal Living, for example. They just raised a funding round on Seed Invest. So you can actually invest in the companies themselves, which is a little bit different than real estate crowdfunding where you're investing in the properties. But there are smaller companies that are starting to try to solve that problem from a modular perspective, whether it's putting ADUs in people's backyards, accessory dwelling units, or building small tiny home communities. There's so many ways that we need to solve this problem because it is just so vast.
Yeah. It really is. And like crowdfunding, it doesn't seem to be going away anytime soon. In fact, it continues to get worse every year, at least as housing prices increase and building costs increase. Affordable housing just becomes harder and harder to access. Well, Deidre, before we go into our last segment, tell our viewers and listeners how they can get in touch with you and explain to us what is Million Acres.
Million Acres is the real estate investing arm of the Motley Fool, which has a 28-year reputation for providing financial advice. So we started a couple of years ago. We have a service called Mogul, which is a service that actually looks at all of the crowdfunding platforms and all of the deals on those platforms and then evaluates them on a 100-point scale. So that's a platform that we have that's an investing service. We also recommend REITs within that. We have a couple of other services that recommend REITs and real estate related stocks. And we also have our free site at millionacres.com. crowdfunding.com. And that includes a variety of crowdfunding platform reviews. So we go through each one. We talk about where the fees are coming from. We talk about the experience. Can you access things on mobile? We talk about returns and quality of deals and all of that stuff. So that's a great free resource for people.
So that's millionacres.com. I've gone to Million Acres many times. Very informative site. Lots of good informative articles on not just crowdfunding, but many different aspects of real estate investing. Mm-hmm. Y'all are doing a great job. Enjoy those articles. Well, Deidre, share with us one of your most difficult setbacks in life, and this could be related to real estate or not. But tell us, how did you come through that time and what did you learn from that?
I think something that was difficult for me was I started a blog. This is like in the early days of pro blogging that eventually was part of a small startup that was bought by AOL. And I ran that blog for about 7 years. And then one day AOL bought Huffington Post and they decided that they didn't want to run this blog anymore and it disappeared. And so that was, all of those years of work and all of the content is now gone. And so I kind of had to figure out what was next. And that's actually what led me to real estate because I had been covering all sorts of luxury. So it was a luxury blog. It covered all aspects of luxury. But part of that was I did a column called The State of the Day. Through that, I talked to all sorts of real estate agents and really saw something interesting in real estate. So my next move after that was to work for Realtor.com. And that got me even closer to understanding how real estate works, what agents do, and falling even deeper in love with the industry.
So you lost the rights to all of your content?
The content disappeared.
Really?
Yeah.
Wow.
AOL did that. And I think a lot of blogs have done that. Sometimes it just disappears. They just close it. They redirect it somewhere else.
Oh my gosh. Well, that had to be heartbreaking and extraordinarily disappointing. Well, Deidre, imagine that you have come to the end of your life. And as you lay on your deathbed, what do you look back on with your greatest sense of joy and satisfaction?
That is an interesting one. I like to think I've got a lot of mileage left. And one of the things I want to do is I want to get deeper into affordable housing. At the Motley Fool, we have a Fool Foundation. And what we're doing is we're figuring out the 5 keys to financial freedom. And we've discovered that housing is absolutely central to that. So I'm hoping that at the end of my life, I will have found a way to make a deeper contribution in that space.
Excellent goals. And I'm sure you do have a long life ahead of you. And it looks like you're living it to the best. Well, Deidre, it has been a pleasure and an informative time with you and a pleasure getting to know you. So thank you for being on the show.
Thank you.
Thank you for tuning in to Real Estate Investing Abundance, brought to you by Steed Talker Capital, a company working for passionate professionals like you to develop financial independence built on solid, passive real estate investments. As part of our effort to make the world a better place, Steed Talker Capital contributes to activities and organizations committed to better understand the equine. These endeavors attempt to enhance the human treatment of horses worldwide. Steed Talker Capital, working for a world where all creatures, great and small, flourish abundantly. For resources to develop your financial independence, connect with us at steedtalker.com.